silver has just hit an extraordinary milestone, breaking through the 72 per ounce level on global markets, a price point that markets had not expected until perhaps years down the road. This is not merely a short-term spike. It reflects a confluence of structural changes in global demand, macroeconomic pressures, and shifting investor behavior that have pushed silver into the spotlight. To put this in context, silver historically traded in much lower ranges compared to where it stands now. Over the past decade, silver's volatility has been characteristic of both its role as an industrial metal and a precious metal investment. The combination of a relatively smaller market and dual-purpose demand makes silver price move sharper and more pronounced than many other commodities, including gold. Why silver prices have surged. The reasons behind this remarkable price surge are multi-layered. 1. Shift in global monetary and market sentiment. In 2025, silver's rally has outpaced even gold in percentage terms. Amid persistent economic uncertainty and expectations of lower interest rates, investors have increasingly shifted their portfolios toward tangible assets. Precious metals like silver benefit strongly in environments where interest rate expectations weaken and currencies, especially the US dollar, soften. When rates are expected to fall, the opportunity cost of holding non-yielding assets like silver drops, making them more attractive. 2. Weaker dollar and rate cuts. Expectations. One of the clearer forces behind silver's rise has been the weakening of the US dollar alongside expectations that the Federal Reserve may cut rates again in 2026. A weaker dollar makes commodities priced in dollars cheaper for holders of other currencies, broadening demand. Meanwhile, rate cuts often reduce yields on bonds and other financial assets, which makes precious metals a more competitive store of value. 3. Industrial demand. Expansion. Unlike gold, silver has a major industrial component to its demand profile. Roughly 40% of global silver demand comes from industrial uses, notably photovoltaics, solar panels, electric vehicles, electronics, and medical technologies. These sectors are not discretionary. They are growing as part of fundamental shifts in the global economy toward renewable energy and digital infrastructure. Increased industrial demand at the same time as investor interest creates upward pressure on price. 4. Supply constraints and mining realities. Silver supply is not perfectly elastic. Many of the world's primary silver producers also produce other metals, like zinc and lead, meaning silver output can be tied to production cycles of other commodities. Additionally, investment in new mining capacity has lagged, partly due to higher operational costs and environmental scrutiny. When supply growth lags behind demand growth, prices tend to rise. 5. Geopolitical tensions and safe asset demand. Geopolitical unrest and trade uncertainty also tend to drive demand for metals. Investors often see metals like silver and gold as assets that retain value better during periods of political or economic instability. The late 2025 rally has coincided with heavier than normal geopolitical risk premiums in markets, which further boosts demand for tangible assets. Given these factors, silver's move to around 72 per ounce reflects more than just a short-lived bubble. It signals a structural shift in how markets are valuing this commodity. Historical perspective on silver. To understand today's price better, it's useful to look at history. Silver has experienced dramatic price swings before, such as during the 1979-1980 Silver Thursday event, when prices skyrocketed before crashing after market intervention. That episode starkly demonstrated silver's volatility and susceptibility to speculative excess. But today's environment differs significantly. The current rally is not primarily driven by speculative single-market participants. It is driven by macroeconomic shifts, real industrial demand, and conscious allocation decisions by large institutional investors and central banks. Fundamentals, demand and supply interaction. A critical part of understanding whether it's a good time to buy or sell involves analyzing supply and demand fundamentals. Industrial demand, the ongoing energy transition, especially solar energy adoption, remains a powerful driver of silver demand. Silver is a key component in photovoltaic cells, meaning renewable energy policy decisions globally have a direct influence on silver demand. Investment demand, exchange-traded funds, ETFs, and other silver-linked financial products have seen strong inflows. When investors move capital into silver ETFs, it increases demand without immediately increasing physical supply, supporting higher prices. Supply side, silver mine production hasn't kept pace with demand growth. Mining capacity expansion is capital-intensive and slow, meaning that as demand increases, supply struggles to keep pace. Traditional inventory stocks have also been drawn down, tightening market availability. Aside from macro fundamentals, technical market dynamics can amplify moves. Many technical analysts point to momentum breakouts, where prices break through psychological resistance levels, like $60 or $70, triggering additional short covering and algorithmic buying. This can accelerate price moves in the short term, even in thin liquidity conditions such as the holiday season. How to interpret the surge? The recent surge has led to differing views among analysts. Bullish scenario. Some forecasts suggest silver could continue to see pressure upward, potentially reaching significantly higher levels if key supportive conditions persist, such as ongoing interest rate cuts, continued industrial demand, and sustained ETF inflows. A minority of analysts even project silver could test $100 or beyond if momentum persists strongly into 2026. Cautionary views. Other analysts argue that after such a rapid run-up, some retracement is possible. Historically, sharp rallies in commodities can be followed by periods of consolidation or correction before establishing a new trend. Indicators such as relative strength levels can show overbought conditions, suggesting that a pullback or sideways trading period could occur before the next major move. Silver's run to 72 Oz has not just influenced metal markets, it is impacting equities of companies involved in silver production. For example, producers with significant silver output have seen sharp stock price movements as higher silver prices improve earnings forecasts and investor sentiment. This illustrates that commodity price shifts can ripple through financial markets, affecting broader asset classes. Given this unprecedented market environment, the key question for investors is this the best time to buy or sell silver? The answer requires nuanced thinking rather than a simple yes or no. When buying silver might make sense. 1. Long-term strategic allocation. For long-term investors who believe in silver's structural demand growth, particularly from industrial sectors like renewables, electronics, and medical technologies, allocating a portion of a diversified portfolio to silver could make sense even at current elevated prices. The energy transition and global technology adoption are not short-term trends. They span years to decades. 2. Portfolio diversification. Silver often behaves differently from stocks or bonds. During times of market stress or currency weakness, silver can serve as a stabilizing element in a diversified portfolio. If an investor's portfolio lacks exposure to tangible commodities or hard assets, adding silver could improve diversification. However, this should always be proportional and aligned with risk tolerance. 3. Cost averaging. For individuals considering physical silver or silver ETFs, a strategy to mitigate price risk is dollar cost averaging, DCA. Rather than trying to pick a perfect entry point, DCA involves buying small amounts over time. This smooths out volatility impact and reduces the risk of buying at a short-term peak. When selling might be appropriate. 1. Profit-taking after major moves. Given the sharp rally silver has experienced this year, more than doubling in price in 2025 alone, some investors may find it prudent to lock in profits, especially if they entered positions at much lower price points. Taking profits does not mean exiting all positions. Rather, trimming exposure can protect gains and reduce vulnerability to reversals. 2. Rebalancing portfolios. If silver has grown to occupy a large portion of a portfolio due to its price rise, it could present an opportunity to rebalance. Rebalancing involves selling portions of an asset class that have outgrown their target allocation, and redeploying capital to other areas that may have more growth potential or lower risk at the moment. 3. Technical correction signals. Short-term traders who use technical indicators may find signals suggesting that silver is currently overbought or nearing resistance levels, which can trigger profit-taking or caution regarding purchasing additional positions now. In such cases, waiting for a technical correction or consolidation phase could offer better entry points. Balanced strategy approaches. 1. Split the difference strategy. Investors uncertain about future price direction can use a split strategy. Take some profits now, hold core positions for long-term growth, and reserve a portion of capital for potential dips or future entries. This approach combines risk management with exposure to possible further gains. 2. Set price targets. Define realistic price targets based on research and risk tolerance. For example, some forecast project silver could trade in a range between mid-50s to high 80s through 2026. If broader macro conditions deteriorate or strengthen beyond expectations, adjusting these targets accordingly can help guide disciplined trading behavior. 3. Pay attention to macro signals. Silver does not move in isolation. Key macroeconomic data, such as inflation reports, interest rate decisions, currency strength, global manufacturing indicators, and major geopolitical developments, should inform decisions. A shift in central bank policy or a sudden uptick in global growth concerns can influence metals markets rapidly. Risks to consider. Before buying or selling. 1. Volatility risk. Silver is historically more volatile than gold. This means prices can make large moves both up and down in short periods. Investors must be prepared for rapid swings and maintain a disciplined strategy rather than emotional reactions. 2. Liquidity risk in physical silver. Physical silver carries liquidity considerations. Buyers pay premiums over spot prices, and selling silver often incurs costs or spreads. ETFs and paper silver reduce these costs, but introduce counterparty considerations. 3. No-yield asset. Unlike bonds or dividend-paying stocks, silver does not generate yield. Its value depends entirely on price appreciation. This means that macroeconomic conditions that favor yields, higher interest rates, could reduce silver's relative attractiveness, potentially applying downward pressure.